CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for August 17th, 2020. Please see our disclaimer for important information. In our first chart of the week, we want to get back to our COVID tracker and give you an update. We haven't had this slide in the deck for a couple of weeks, but it's a good time to do a quick check back because obviously, as things have evolved throughout the summer, we want to kind of paint the picture of where we are now. So this is our chart that we are accustomed to. It has the lines, at least, which is what I want to focus on, are the 7-day moving averages for both the new positives in the blue line, and then an orange line represent the daily deaths on that 7-day moving average. And as you can see, at least from a death standpoint, basically the end of June through the bulk of last month, we were really in kind of a tough spot with regard to rising cases as well as deaths, and both of those numbers were trending up through July, and that's when we had a lot of increased speculation on closures, and a lot of states were kind of retrenching and going back on some of the things that they had done to open the economies. But having said that, you can see that there's been a leveling off of sorts, if you will, in both the new case positives as well as daily deaths, albeit at least on the death side, higher levels than what we saw in May, late May and into early June, but at least they've leveled off, and we're in a similar spot with regard to positive cases. So obviously we want to continue to monitor that going forward. So this is a chart that we've got a left and a right axis. Basically, it plots the number of states that have increasing positive tests and what those states represent as a percent of the U.S. Total economy. And so, as you can see, back in April, we had basically all 50 states were reporting increasing cases. That's when we had basically the outbreak of the emergence of the pandemic, if you will. And in July, we had the resurgent and a lot of the rise in caseloads along the Sunbelt states, California, Texas, Florida, Arizona got a lot of publicity. But as you can see here, after a couple of months where that number dropped down kind of below 30, we had a spike. Basically, almost all of the states in the union had rising cases, and those states represented essentially all but perhaps maybe 10% of the economy. But having said that, as we've seen the caseloads drop, and as you saw in the chart on the prior page, we've had kind of a dropping off in number of positives. And so right now where we stand is essentially we've got about 15 to 17 states that are now evidencing increasing positive cases. And of those roughly 15 to 17 states in the union, they represent more or less about 30 to 35% of the total U.S. economy. This chart comes to us by way of Statistica, that does a lot of data compilation, and apparently the source that they're using for the data comes from New York Times article. And I came across this. I thought that was kind of interesting because people spend a lot of time talking about, well, when do we get back to a normalized type of economy, even though we've had permanent destruction that we'll have to rebuild. And people talk about one, obviously a vaccine or herd immunity. And so this is really the latter of those. And I'm going to caveat that I'm not sure exactly what the science is behind that 60%, but at least this is from an article in the New York Times. So I wouldn't necessarily read into the absolute numbers per se, but just say, use it for illustrative purposes, that in looking at these major cities and where the antibody estimate, this would be like essentially the percent of the population that has antibodies for coronavirus. As you can see, they're well below that 60% threshold. So I think really the takeaway from this slide is, regardless of the numbers, that we're clearly a long ways away from having that herd immunity. So I've got a couple of extra charts here that kind of, again, just paint different pictures for us. we've had high frequency data. We know that travel and leisure has been adversely impacted, and there's been a lot of speculation as schools have begun to reopen. What are the issues incumbent there? And I don't intend to go into a lot of detail here, but just show some things that I think have some representative value within the context of those discussions. So the Airbnb occupancy rate, again, that's hospitality. That's an indicator of a proxy for travel and leisure. And you can see occupancy rates in January, which during the winter, if you get past the New Year's holiday week, would typically not be a terrific, terribly high number. But as you can see, you get down to May and June, at least those 2 months were flat, but they're at an extremely low level. So you can see the impact of the pandemic here. And then on the flip side, kind of changing the subject on the same slide, if you will, we have this chart that comes to us from the American Federation of Teachers that shows really the costs that are incumbent with opening schools the way that they need to be in a safe way. So I thought this was kind of illustrative of some of the costs that aren't necessarily being talked about. There's just a pure safety issue that seems to be getting all the headlines, but there's a lot of significant costs that are having to be borne by the districts at a time where they've got some serious budgetary concerns. Kind of playing on some of these high frequency indicators and what people are doing in the wake of the pandemic when they're sitting at home in front of their laptops. I mean, this is kind of an indication of what people are searching for. And I believe that these are Google trend, and maybe the slide is perhaps a tad bit fuzzy, but what it shows you is that there's a baseline, which is essentially that intersection of searches relative to the baseline and whether they're trending higher or lower. And you can see that basically if you're below that intersection point and to the left, that means that not only are you trending lower, but the amount of searches are exceptionally low. And not too surprisingly, we're not seeing a lot of searches for bus, rail, air travel in general. And even as you kind of go up and to the right, car rental, children's clothing, clubs and nightlife, those things are intuitively not getting a lot of search pull, if you will, in the wake of the pandemic. But and then perhaps maybe also intuitively, as you see on the upper right, the searches that are higher than they have been on a trend line basis, like consumer electronics, home appliances, major appliances, and even autos getting a little bit stronger look, and those searches are actually increasing. We've talked about bankruptcy filings. We've talked about the health of the corporate sector and particularly the health of the small business commercial sector. And what this shows us is, even though we've had a fairly strong spike in bankruptcies, in fact, overall bankruptcies have eclipsed 2009 levels. And, we've got a lot of press addressing a lot of different things going on, but that there's this underlying health of the U.S. Commercial and corporate sector that I think is still at some risk here. And if this is any indication, the red line represents the traditional mean percentage rise in bankruptcies, and they tend to peak about 5 to 6 quarters after the typical recession. And so obviously we're fairly early on in this post-recessionary environment, if that is what it in fact is. But suffice it to say that we could continue to see a rise in bankruptcy cases as we go along here over the next year. So a quick update on the policy response. We've got a couple of charts related to that, and then we'll kind of move on into some of the market-related items. But you can see here we've had unprecedented policy response to this. And there's some read through in this in the sense that there's a lot that's been authorized. We still have a fair amount of stimulus that needs to be dispersed. Some of this may even pertain to like the Federal Reserve's Main Street lending program and things like that. Legislative actions, obviously there's monies that have yet to be dispersed. And so this is actually some of the speculation that, interestingly enough, is holding up some of these negotiations in Congress regarding a follow-on stimulus package. This is a chart from Morgan Stanley that just kind of shows us on a month-to-month basis where these disbursements that have already taken place have come from. So as you might imagine, government transfers have accounted for a significant amount of what happened in April and May, and obviously April were the stimulus payments and things like that were the $1,200 checks that were hitting people's bank accounts rather. And then we have unemployment benefits, and then there's the unemployment base below that. You can see that transfer payments have decreased April to May, and really not, I wouldn't say vaporized, but they've all but gone to zero. Again, waiting for that next stimulus package, which, you know, more transfers are being discussed. But as you can see, the benefit supplement, the $600 a week, June, July, and we know that heading into August that's basically going to taper off until such time that those benefits are reinstated, perhaps reintroduced at a lower rate, or in some form or fashion provided out to unemployed, or perhaps even with an income threshold or something like that. State and local governments are another item of concern for all of us. We know that budgets are going to be constrained. We know that most state and local governments have to balance their budget, and so if they are not going to have the revenues from sales taxes and perhaps even, you know, from property taxes hitting their general fund, that they're going to have to cut spending. And we know that there's probably 1 million jobs that have already been impacted at the state and local level from COVID-19 related impacts. And this chart just shows us that spending, or is defined as consumption and investment, has already gone down about 6% from the prior period, as reported to us here by the St. Louis Federal Reserve. And I would expect that number to continue to go down at precisely the same time that states are being asked to shoulder perhaps a larger share of the burden for not only the healthcare costs related to Medicaid, but other things related to essential services and maintenance and operations. A quick comment on the labor market. We've got two charts up here. I wanted to show you that I would say that this is probably, you know, the left-hand side is a little bit more positive, the right-hand side is a little bit more sobering, but let's start with the positive first, and that is that job postings have in fact started to move a little bit higher from data that's been compiled by Opportunity Insights and as reported by Barclays Research. So that's a good thing. This data is through the end of July, so fairly fresh, even at a time where we had rising caseloads and some states were closing or reclosing parts of the economy or scaling back some of the reopening. That despite that we had an uptick in job postings, so that's a positive element. Now on the right-hand side is just it's a sentiment figure. It's a sentiment survey, if you will. So it's taking, the University of Michigan does these surveys, and so it's just a measure of whether households are more or less worried about the labor market. And this particular question that was asked was, you know, what is a probability of losing a job here over the next 5 years with this uncertainty that lays ahead for the recovery of the economy, with tax rates, and with the viability of end markets, you know, regarding if people are doing business overseas, what's the health and vibrancy of global trade environment going to look like years down the road, with China and the U.S. going head to head in kind of a new Cold War, if you will. Anyway, the net of all that is reflected in this chart here, which actually shows that there's been a fairly meaningful spike in anxiety, as I'll call it, for the risk of losing jobs over the next 5 years. And so we know that if the consumers are feeling this way, there is likely to be a response in spending, spending sentiment. We know that sentiment numbers have kind of rolled back over a little bit. So, you know, that this is something that we definitely need to pay attention to. So getting over to our markets, if you will. So we know that over many years now, we've seen equity outflows, we've seen more bond inflows, you know, again, over a period of time. That's in the left-hand chart. So that's not a new trend. Now, we did see a bit of a reversal in the wake of COVID-19, where we had some, this represents the S&P 500 chart here on the top. Down below is the basically the fund flows for equities, and they really dropped off a cliff when volatility perked up. But even though the S&P is kind of almost reattained its all-time high, you can see that there's just been a tremendous amount of equity outflows, precisely as we have, you know, been in this uptick following March 23rd. On the right-hand side, though, it's interesting. We've seen these equity outflows at a time where, you know, we basically have gotten through all of the second quarter earnings reports now. So we're by and large all done now. And we know that the reports were bad. However, in these earnings calls where management talks about what they see and what they hear and what they feel, that we actually had a fairly strong spike in mentions of the word optimistic or optimism in some of their comments. So I think that's pretty telling. So there, you know, you can really boil this down to the fact that CEOs and company leaders, I think, are a little bit more optimistic than investors are. Investors are pulling their money out. CEOs are a little bit more optimistic, certainly above average, as was compiled by FactSet, and I know B of A, Merrill Lynch has done a lot of work on this in their quant team. So kind of interesting dichotomy here. This is rather interesting, the dividend aristocrats versus bond yields. So the dividend aristocrats are basically the highest and most stable yielding S&P 500 companies, or companies in the S&P 500 index. And so what you see here is the relative performance of those strong companies. And I'll just call them strong companies, but they're high dividend payers and stable dividend payers. So they have not been performing well relative to the index. And typically, when you see U.S. 10-year Treasury yields, and that's you know, basically when rates go down, the relative performance of the dividend aristocrats goes up to the rest of the index, meaning that when rates are down, that these so-called dividend aristocrats generally do better than the market as a whole. But that's not playing out right now. So 2020 has been a completely different story. And I think this is a kind of a profound chart, in fact, because I love, I'm a very strong student of trends, and you can see that there's a reasonable correlation of interest rates moving down and dividend aristocrat relative performance going up. But that is completely broken down this year. So rates have gone down, and so has the relative performance of these high dividend companies. And what that means is that just that dividend payers overall in the market have been relatively unloved, and arguably are at a much better value point, or point of entry value point relative to the rest of the market. And I think we're going to really end on something that I think is going to have more relevance in terms of financial planning. As we sit here in 2020 and we start to work with our clients and kind of reset our thinking with regard to what do the next 5 and 10 years look like, and maybe even the next 15 years. But if we go back to 1997, which is in kind of that aqua colored dot on these screens for these various sources of yield for a portfolio, and we know that, like for the stock market, over the last 25 years, that more or less 40% of the total return of the stock market has come from dividends. And now on the fixed income side, because interest rates have been trending down for a while, we know that we've had a lot of influence from capital appreciation in bond returns. So we don't think that's going to be the case as much, because rates are just so low, they don't have that much more room to fall. But what this chart shows you, and let's just take U.S. equity first, that blue dot, 1997, the average yield on the stock market was about 2%. The volatility, which is a measure of the volatility of returns from year over year, basically it's a proxy for risk. The risk was, more or less on a trailing 5-year average was maybe about 6 to 7%. And now that number is approaching 16, 17, and I've seen some studies 18%, depending on how you approach that. So you're not yielding that much more, as you can see here, but you're having to entertain a lot more volatility in equity portfolios. Now on the fixed income side, you look at treasuries, core fixed income, you can see that yields have all come down. Good news is that volatility has actually maybe gone down a little bit, but your yields have fallen precipitously, so you're not getting that yield. Equities, you're not getting any more yield. Really, you've got to go out and get high yield, which is low rated, in some cases junk bonds, in some cases prefers, and some other types of things, but your highest rated and safest credits are all yielding much, much less. Corporate high yield is really not yielding any, as you can see on the top of this, it's not yielding much different than it did back in 1997, but it's gone up in risk. So here's the backdrop, at least from an income standpoint, that we're going to have to face for the next market cycle, I'll call it, is that we've got lower yield opportunities. If you want yield, you're going to have to go down a little bit in the credit layers to get it, meaning less credit stable or credit worthy companies to get a higher yield, and to get the same yield that you got, roughly, call it 23 years ago in the equity market, you're going to have to absorb a little bit higher risk. And so longer term portfolios will be less impacted by these kinds of things. But the yield picture is having to make us think a little bit differently about how we're going to get, how we're going to approach asset allocation going forward. So without giving necessarily a lot of minutia in this, it's just important to say that there are different ways of addressing this particular issue that are certainly not kind of this conventional thinking that we've all been used to for the last 20, 25 years. And in the final slide of the pack for this week, we just have a stock market valuation in US dollars, and a trend line for global economic growth. And so without really needing to jump into what the actual data says, it's just important to realize that you look at the shaded boxes here, and this is where the market has exceeded global GDP, or basically the world economy. And in the case of 2006, 2007, that presaged a recession. And when we talk about, we go forward to 2018, we had the same thing happen, and it presaged a correction, if you will. We weren't in recession, but it presaged a correction. And we also hit that point basically in January of this year in front of the pandemic. And so obviously the pandemic made the drop worse, but we battled back to a point where we basically got to where we were in January, which is really profound given kind of these global dislocations and supply chains and consumer behavior and fiscal condition for not only companies but governments. All of this massive amount of dislocation, and here we are with the stock market basically reattaining its or eclipsing the GDP level. So that's all we have today in the charts of the week. We hope you've enjoyed what you've seen here today, and we welcome your suggestions or comments. The contact information you see below. Hope you have a good week, a safe week, and we look forward to seeing you again next week.